This is a recording of the Learning Unit 1 presentation slides that we compiled on TAX2601, and we hope that it will assist you when you work through the learning material. It is, however, very important for you to take note of the fact that the presentation does not in any way replace the content in the Learning Unit content document. The learning material in the content document, together with the prescribed textbook, represents the full syllabus and must be studied in its entirety in order for you to be able to pass the module. We will be covering the topics in Learning Unit 1, and these topics are tax law, objection and appeal, the different types of tax imposed in South Africa, and we will also have a quick look at the normal tax framework. Learning Units 1 and 2 are only assessed in Assessment 2, that is Quiz 2. It is not assessed further on in the semester again. The first question that you would wonder about is, what is tax? Now, tax is defined as a compulsory contribution to state revenue. And then the big question is, why do we pay tax? We definitely do not pay tax because we want to. We pay tax because there's a social contract between the state and its citizens. The state offers its citizens protection and creates prosperity. And to enable the state or the government to do this, the citizens need to fund the government by paying taxes. There are a large number of different taxes imposed in South Africa, and here we provide you with a list. The ones that you will mostly deal with is income tax. Together with that goes capital gains tax, which is somewhat of a misnomer, but later on in the presentation I will just explain that. Then there's also turnover tax that forms part of income tax, as well as dividends tax. And then the very well-known one down here is what we all deal with on a day-to-day basis is value-added tax. And then there are all these other numerous taxes that is effective in South Africa. Now, you may think that tax consists of the calculation of how much tax you need to pay. However, tax is in essence a law subject, and therefore we have the term tax law. Now, tax law consists of primary and secondary legislation, as well as the interpretation of tax law. And under interpretation of tax law, we include case law. We also include the objection and appeals process here in Learning Unit 1. It is actually part of the Tax Administration Act, which we deal with in Learning Unit 2. But it sort of interconnects with each other. SARS is the South African Revenue Service is the administrator of the Tax Act. It enforces the tax legislation, and SARS is an autonomous and independent section of government. The Income Tax Act gives the Commissioner of SARS certain powers and duties. Just note that the terms Commissioner or SARS are sometimes used interchangeably. Okay, let's first deal with primary legislation. The so-called rules of tax are stipulated in an act, and an act is approved by Parliament and duly signed by the President before it becomes law. In TAX2601, we mainly deal with the Income Tax Act and to a limited extent with the Tax Administration Act. There are a number of other tax acts as well, which you will encounter at some time in your tax studies. And here we mention a few. The Transfer Duty Act, when fixed property is transferred. Estate duty that comes in when a person passes away, etc. The Income Tax Act and the Tax Administration Act are amended on an annual basis. and this is linked to the budget process of the government. Just to mention here, the fiscal year of the government is from 1 April to 31 March, and this annual process, budgeting process, is explained on pages 4 to 5 of the content document. Please take note of it. Now, the tax acts are referred to as primary legislation. The Income Tax Act is structured and divided into chapters and parts and sections, as well as 11 schedules. The sections are mostly used to reference the stipulations in the Act, and these sections also have paragraphs, subparagraphs, and provisos. And as time goes on, you will get familiar with how we refer to the Tax Act. The original Income Tax Act was promulgated in 1962 and the original Tax Administration Act in 2011. Amendment acts are published annually and stand as separate acts. However, the Income Tax and the Tax Administration Amendment Acts, once they are approved by Parliament and signed by the President, they are incorporated into the original Income Tax Act and the original Tax Administration Act. And therefore you will find when we refer to, for instance, the Income Tax Act, that we refer to it by saying the Income Tax Act number 58 of 1962 as amended. We also have secondary legislation. In addition to the stipulations in the primary acts, the Minister and SARS also issues regulations and notices. And the legal standing of secondary legislation that it is equal to law. Regulations and notices, including double tax agreements, are binding on SARS and taxpayers and is referred to as secondary legislation. You can really feel free to visit the SARS Legal Counsel webpage. I posted the link here. It would be very interesting for you to see how they present their legal counsel page with primary and secondary legislation. And right at the bottom, you can see their legal counsel publications. That is where you will find SARS guides. And here, the third from the top, you also find interpretation and rulings, where you can find interpretation notes, etc. Right, now we come to the interpretation of legislation. Now, tax statutes are not always clear and unambiguous, and it must consequently be interpreted. There are certain laws and tools available for interpretation of the acts, and these are, firstly, we get, or one of them is SARS's interpretation notes, previously called practice notes, and binding general rulings. There's the Interpretation Act 33 of 1957. Then there's also the Rules of Interpretation of Statutes. And then there's case law. Interpretation notes and binding general rulings are not binding on the taxpayer. An interpretation note only sets out SARS's interpretation on a specific matter. There are also binding class rulings and binding private rulings that have different binding authorities. And you can find these rulings on this link if you just want to have a look at it and take note of how it is, the information is presented there. Under rules of interpretation, we need to take note of the fact that certain and specific terms are usually defined in the primary legislation, in the primary act. For instance, in the Income Tax Act, in Section 1, there are a large number of definitions of terms. However, if a term is not defined in either the Income Tax Act or in another tax act, then the Interpretation Act should be consulted for guidance. If a term is defined in both the Income Tax Act and the Interpretation Act, the Income Tax Act takes precedence unless now the context indicates otherwise. If the term is not defined in either the primary legislation or in the Interpretation Act, the ordinary dictionary meaning may provide guidance, or alternatively, case law must be consulted. And further on in the module, you will deal with the gross income definition. It's a long definition in Section 1 of the Income Tax Act, but that has led to many court cases in the past, and well, even so today. And the principles that are laid down in the case law is then used to interpret certain issues that we encounter when we have to decide whether something is gross income or not. Another example here is the term day that is not defined in the Tax Administration Act, even though some of its requirements of this act refers to days, not business days. Business days is defined in the Tax Administration Act. Very interesting for if you want to just go and read the definition of business days in the Tax Administration Act. In this instance, regarding the term day, we consult the Interpretation Act that stipulates that day refers to a calendar day and not a business day. Now, the original intention of the legislature is usually explained in an explanatory memorandum. And the explanatory memorandum is published together with an amendment bill. And at this link, you can have a look, just for interesting sake, at some of the explanatory memorandums. Then we also deal with the contra fiscum rule. The contra fiscum rule means that where a provision or a stipulation in the Act is open to more than one interpretation, the interpretation that favors the taxpayer must be followed. This is also in agreement with the spirit and the purport of the Bill of Rights. And then for more information on the different approaches to the interpretation of statutes, please read the information on page 11 of the learning content. This brings us to tax disputes. The taxpayer and SARS will not always agree, and therefore the Tax Administration Act provides for an objection and appeals process. Firstly, a taxpayer may request reasons from SARS for an assessment. This must happen within 30 days of the date of the assessment. The Commissioner must also within 30 days show that reasons were given, and if not, it has 45 days in which to provide reasons, with a possible extension of a further 45 days. The taxpayer may also lodge an objection to an assessment. And this is now within 80 days, which is a new amendment, from the date of the assessment. And for this, the taxpayer must use either the ADR1 form for a physical submission or the NOO e-filing submission and provide the grounds for the objection. If an objection complies with the requirements, the Commissioner has 60 days to decide on it. It is not possible for us to list all the days, the number of days here. Remember that the quiz is an open book quiz and you can refer back to your learning material. However, to do the quiz in the allocated time, you must be prepared. So it is advisable that you prepare yourself well when reading through this part of the study material and marking for yourself all the specific instances of days that is mentioned. Once the objection process has been exhausted, a taxpayer may lodge an appeal. And here it is the ADR2 form or the NOA form if it's for the e-filing submission. And then when appealing, the taxpayer must indicate whether the ADR process must be followed or whether it wants to proceed to litigation. And then upon choosing litigation, the appeal will either go to the tax board if it's less than 1 million rand, or it will go to the tax court if it is more than 1 million rand. And keep in mind here that the burden of proof is quite important. You can read more of that in Learning Unit 2, and it is Section 102 in the Tax Administration Act that deals with this. Okay, when we look at case law, once the objection process has been exhausted, the taxpayer may appeal, and instead of choosing the ADR process, the taxpayer may directly choose to litigate. There are also instances where SARS choose to litigate, and it has happened in the past when there are really important principal matters at hand that, now this normally deals with large corporations, not with individuals, but with large corporations, that both the taxpayer and SARS chooses to take the matter to the courts in order for the courts to lay down the correct principles for future reference. Litigation will follow. It will either start at the tax board or at the tax court, and then it will go on to the provincial division of the High Court, and eventually to the Supreme Court of Appeal. Now, over the years, many court decisions have laid down the interpretations of the tax statutes in South Africa that we still use today. And once we come to the gross income definition, further on in the module, you will see how interesting it gets. The English law principle of stare decisis is accepted in South African law, and this is called legal precedence. And this means that the lower courts are bound by the decision of the higher courts. That means the higher court sets the precedence. In the case law, in the case, the ratio decidendi part of what the judge or judges write there, that is the portion that the lower courts are bound by. However, the stipulations in an act remains the main authority. If government do not agree with a court decision, it can change the act to enact its goal with the law. Now, this has happened in the past. When SARS anticipates a specific outcome in case law, it already had the law amendment ready to be submitted. And that submission is then sort of quickly pushed through the parliamentary process. That is fine. There's nothing wrong with government doing that, as long as any stipulation does, not just amendments, any stipulation in an act does not go against the Constitution of the Republic of South Africa, because the Constitution is the supreme law in South Africa. Now, there's a specific way in which court cases must be cited or referred to, and this information is on pages 16 and 17, and it is very important for your studies to take note of how we refer to case law. Now, this slide is just here for you to take note of the terminology. We have income tax, we've got consumption tax, and we've got wealth tax. You can see there in the second column. But it then comes down to income tax. In the Act, the Income Tax Act is called normal tax. So you pay normal tax, but normal tax is an income tax. And you pay value-added tax, but value-added tax is a consumption tax. And you pay capital gains tax, but capital gains tax is a wealth tax. So the second column is a classification of the type of tax. Income tax is imposed on income. Consumption tax is imposed on the sale or the use of commodities, whereas a wealth tax is imposed on the transfer of property or wealth. And examples here are the normal tax rate for companies is currently 27%. It was previously 28%. Natural persons and small business corporations pay normal tax on sliding scales. And here you encounter two further terms. When tax is levied at a fixed rate, we call it a proportional tax. But where it is levied at the sliding scale rate, we call it a progressive tax, because progressive tax means the higher the income of the person or the entity, the more tax that person or entity will pay. There's also some transactional taxes that you can just take note of. Okay, now in South Africa, income tax is imposed on the income of any person. And the term person includes both natural persons and legal entities. This is now defined in the Income Tax Act. The liability for income tax is calculated on an annual basis and is referred to in the Income Tax Act as normal tax. Normal tax is levied either at a fixed rate, as we've just covered now in the previous slide, which is a proportional tax, or at sliding scale rates, which is a progressive tax. A progressive tax rate means that the higher the tax base or your income or your taxable income, the higher the rate of tax that you will pay. Certain entities like companies are taxed at fixed rates, currently 27%, whereas natural persons, special trusts and small business corporations are taxed at progressive rates. Normal tax is calculated on taxable income on an annual basis, which is for a year of assessment. The year of assessment for natural persons and special trusts are always end on 28 February. Whereas the year of assessment for companies, closed corporations and trusts, including small business corporations, coincides with their financial year. In other words, the 2023 year of assessment for an individual is 1 March 2022 up to 28 February 2023, whereas the 2023 year of assessment for a company with a December financial year end will be 1 January 23 to 31 December 2023. Now we can have a look at the normal tax framework. You must remember there is a difference between the net profit and taxable income. Net profit is used for accounting purposes and taxable income is used for tax purposes. In practice, usually the net profit is your starting point and your net profit is adjusted to calculate taxable income. However, for the purposes of this module, we teach you the tax framework method. So you use your tax framework to calculate taxable income. Your tax framework starts with gross income, and as previously mentioned, gross income is a term that is defined in Section 1 of the Income Tax Act, but it has also led to many court cases because the interpretation is not so simple. You start with gross income. From gross income, you need to deduct any income that is specifically exempted from tax, and that will give you a figure for income. And income is also a defined term in the Act. From income, you must deduct deductions, allowances, and assessed losses. But then you must include in income amounts that is specifically stipulated in the Act that must be included in income. And later on in the module, you will see that these are the recoupments of wear and tear allowances. That brings you to taxable income before capital gains. And then here you add a taxable capital gain. And this brings us to the point that I mentioned earlier, that we've got somewhat of a misnomer here, because we speak about capital gains tax. But capital gains tax isn't really, well, it isn't a separate tax. It is normal tax that you pay on the taxable portion of a capital gain. So the taxable portion of the capital gain is added to taxable income, which gives you your taxable income for the year of assessment on which your normal tax will be calculated. Then you also have a framework for the calculation of your normal tax liability. Your normal tax liability starts off with calculating either the normal tax at a fixed rate or on the sliding scale rates. From this, there are some rebates that can be deducted. This, for your purposes, you can ignore because it mainly relates to individuals, and only in your third year or further on you may encounter a specific rebate that can be deducted from normal tax liability. Then this gives you your normal tax liability for the year of assessment. From this you deduct any prepaid taxes, which is provisional tax. So the taxpayer pays provisional tax at 2 time periods during the year, and that prepaid tax is then deducted. And that brings you to the amount that is either still due to SARS, or if the provisional tax was too much, then there's an amount that is refundable by SARS. And this is then calculated on assessment once SARS assesses the taxpayer. And just some terminology. Please take note that your effective tax rate is your normal tax liability for a year of assessment divided by the total income for accounting, whereas your average tax rate is your normal tax liability for the year of assessment divided by the taxable income. And another term that you will encounter is your marginal tax rate. And this is an important concept for decision-making purposes. And you also, it applies, marginal tax rates applies when you use progressive tax rates. In other words, where the tax rate increases as the income or the taxable income increases. And the marginal rate is the tax rate that is applied to the last round of income earned. This ends this presentation, and we really hope that it will just assist you in an audible way to get you started working through the study material for Learning Unit 1.